New year, new numbers, and what we want to make sure here is that you're well aware of these numbers that you can focus on here, whether it's your personal retirement plans or relative to your personal planning. Of course, we'll be discussing these and making sure that you are maxing out all these appropriate buckets if it pertains to you. But why don't you kick it off, Molly, and talk about 401k plans?
Yeah, so with 401ks, the employee contribution limit has increased by $500. It's up to $23,500. The other thing to keep in mind is that this catch-up contribution has remained the same at $7,500. What's unique though this year is there's actually a provision called the Super Catch-up, which is eligible for participants aged 60 to 63. And that's an $11,250 contribution. That's the catch-up amount. Don't know why they settled on that limit, but that's the amount for this year. So certainly within your plan, you want to ensure that you're maxing out that contribution amount if you're eligible. Not all plans have all the intricacies figured out behind the scenes, so you want to check both the percentage of contribution as well as your dollar amounts, regardless of your participation in the Super Catch-up, to ensure that you're maxing out all of those different limits.
Yeah, but it's an additional $3,750 that you can put in. So, certainly that's still an opportunity, and as Molly mentioned, we encourage you to be proactive there. And then the other thing I always like to remind is that if you do turn that magical age 50 this year, no matter what time you do turn that age, throughout the year you can actually start that contribution today. So if your 401k administrator doesn't allow that, make sure you're just proactive there and make sure you are getting that money into the account as soon as possible, as long as you can afford to do so. And then finally, that $23,500 for everyone else, that is a number that is your own money. A lot of questions we get from participants of 401k plans or other clients is that, does that include the company contribution? So that is your own hard-earned money that you can put in, pre-tax or Roth, hopefully, and certainly that's a focus of attention here for 2025.
So touching on IRA contribution limits for 2025, IRA limits are actually remaining the same. $7,000 for a basic contribution, whether it's IRA or Roth IRA, additional $1,000 contribution for the catch-up if you're over the age of 50. So just something to be aware of. If you haven't made any 2024 contributions for IRAs or Roth IRAs, you actually have until the tax deadline to do that, Tuesday, April 15th. So certainly take advantage of that. Otherwise, go ahead and move forward with those 2025 contributions. I know we're assisting clients with backdoor Roth contributions currently. Another item is HSAs. So looking at HSA contribution limits, those have increased for this year. Contributions are at $4,300. For a family, you can contribute $8,550. With the HSAs, two things to keep in mind. If you're over the age of 55, you are eligible for a $1,000 catch-up contribution. The other thing to keep in mind is that HSAs allow you to make contributions up until the tax deadline. So if you didn't make your contribution for 2024, you can certainly do that until April 15th. But we want to ensure that if you have the option to deduct that from your payroll, because you're actually saving an additional 7.65%, the FICA tax, by having that deducted directly from your payroll for the 2025 contribution. So certainly something to just make note of. Again, this kind of applies to 401ks and HSAs, but check those pay stubs because that's how you're going to know what you're contributing in this given year.
Let's jump into 529s. Certainly this is an area of focus for a lot of our clients, especially as they're saving for their children's education. No major changes relative to the dollar amounts that you can contribute to there. One thing that as we focus on the contributions is that it is subject to the annual gifting limits because these dollars that you're putting into there are gifts technically to your children. So that has changed from an exclusion amount. That's actually gone up to $19,000 a year, up from $18,000 last year. But in addition, still with 529s, you have the ability to put 5 years of contributions into those in one calendar year. This is a special technique that can allow you to bypass some of those annual gifting rules. The caveat there is that you cannot contribute for another 5 years. So if you're looking to kind of stack that contribution into there, come to us, ask questions, and certainly we can make sure you're in compliance with that as well. Inherited IRAs, it's been a big topic really since 2020, where ultimately as some of the laws have changed, the stretch IRA rules have changed. And now, if you inherit an IRA, you have to take that out within 10 years. But the outstanding question was, if the person was taking a required minimum distribution that passed and that you inherited that money from, do you need to continue to take that RMD going forward? Well, in the past, the IRS has been very lax on that and has kind of said, no, you don't have to take it, or there's going to be no penalty if you don't take it. Well, 2025, that's back online. So again, if you have taken or inherited money from a loved one into an IRA account, and it's under the inherited IRA structure, just keep in mind that you will have to take a required minimum distribution, especially if that person was subject to required minimum distributions before passing. Okay. And finally, we already touched on this a little bit, the annual exclusion amount. This also just ties into long-term legacy planning and gifting planning. Now that it's up to $19,000, if you are gifting to your children on an annual basis, make sure that you do not exceed those limits. Otherwise, again, there will be some additional reporting there. So these are all things, again, that will encompass into our meetings throughout the year. And certainly, these are just a small segment of the numbers to come here. Let's jump into the next topic as we think about taxes. This is definitely something slated and it's important for this year, especially as if you think about in 2017, when a lot of tax laws went into place, those were scheduled to sunset at the end of 2025. That's personal income tax brackets, estate tax limits. Certainly, I can't believe we're already here, for one. But two, big question mark is what's going to happen going forward. And through the election process, this was a topic of discussion, and certainly with a Republican sweep, the probability of these tax laws getting extended or even improving from here to the benefit of individuals and families, the probabilities have gone up. But I think as we stand here today, it's still too early to tell. But these are the kind of the focus points we want to just bring to attention today that we're going to be watching throughout the year, because as new information comes down the line, this is going to impact individuals and families, year-end planning and how they're thinking about maximizing the tax brackets or the personal balance sheet, throughout 2025 here. So, Molly, why don't you hit on the first one?
Yeah, so with the personal income tax brackets, it'll be interesting to see what develops here, but certainly the current tax law changes show that the top tax bracket maxes out at 37%. To your comment, Neil, we'll see if we can see some improvement within the specific brackets, but that is something that we'll be looking at closely and certainly diving into in our tax modeling software.
Yeah, and even thinking about when these tax laws went into place, I would say there was a little bit more of a marital deduction, we kept calling it, just because the tax brackets were much more favorable for married filing joint versus single filers, and that's something to watch closely as well. Another item we're watching closely are personal deductions and credits. This is an area that a lot of folks were impacted in 2017 when there was a cap on state and local income taxes, which included your real estate taxes. So that was capped at $10,000. But also what went into place in 2017 was the doubling of standard deductions. So it really revamped the charitable contribution discussions, ultimately understanding how that's tracking each year to make sure that you are getting a tax deduction for your gifting. But right now, the standard deduction is at $30,000 per person or per married filing joint. So that's significant. So again, if you're not above that $30,000 in deductions, ultimately, and you are making charitable gifts, you're not getting tax deduction. So if they do uncap the $10,000 a year, what will they do with the standard deduction? These are all important items because this could impact if you take action today in 2025 or if you decide to wait until 2026. So this will be an item we'll be watching very closely there. The other one we're keeping an eye on is alternative minimum tax, AMT. We haven't seen this a lot since 2017, and the driver was that because a lot of deductions have been limited. And typically where you see AMT come into play, where you have a lot of deductions out there, and ultimately that's something we're going to keep a close eye on because if you have stock option income, charitable gifts, a lot of real estate taxes, for example, also mortgage interest, those are all factors that can drive your ultimate deductions per year. So we'll keep a close eye on that one. Why don't you hit on the last one, Molly?
So looking at the federal estate tax limit, this year it's set at just shy of $14 million. And as we mentioned, the tax law changes that we're expecting at the end of this year would bring that back down to $7 million. Certainly that doesn't seem to be the case based on kind of the tax landscape that we're going to likely see evolve here. But that would mean if there was a reduction that families who don't necessarily have taxable estates potentially would. The other thing, though, to keep in mind is that there are states that have estate tax limits. Illinois, in fact, has one at $4 million. We've talked about that before. But certainly that's something that is, at this time, not changing and something to keep in mind from a tax perspective.
Yeah, and definitely does not eliminate the opportunities for planning, especially if you're not at that federal level. So a lot of opportunities to be proactive there, no matter what the outcome is from the federal standpoint. Obviously, managing the estate tax is critical as well. Awesome.
Mm-hmm.
All right. Well, that concludes our topics here today. Certainly, plenty more to come, as we'll be reporting on a monthly basis of what's evolving from a tax standpoint, or any other big topics that might impact your own wealth accumulation or even wealth preservation strategies as well. So thanks for joining us, and we'll see you next month. Thank you.